Some
Yeah.
some are managed by property managers in different areas, different property managers. Kind of have to separate them out just to keep smaller and effective handyman taking care of things.
Mm.
And then the rest of it is mostly development. And I'm doing recently a hotel, which is a historic building, which we're restoring and going for tax credit deal. So
Nice. Nice. That's
So
that's
you bought,
amazing.
oh,
Go ahead, Benoit.
I was just saying you bought a hotel and you're improving it to get higher rental price or
no, I bought a building which was vacant, and it had been sitting vacant for a number of years because the previous owner ignored the building. It's a historic building built in 1875, and I'm restoring it and putting a hotel in there. Uh, so it's the building itself, and there's another parcel next to it. I'm putting about 68 rooms in there, and there's a hotel. There's going to be a restaurant, a little speakeasy, cafe. A few F&B outlets. Initially we were doing a bigger project, which was going to have 155 rooms,
Mm.
and we're adding 8 more stories on top of the existing 5-story building, and it's just getting to be very expensive. Because given a historic city, you have to save the facade of the building. And so we scaled it down, and now we went for historic tax credits, and that allows you to get money from the federal government and the state government. Roughly, it helps you with the cost of construction, and the numbers make sense at that point for the project. So,
Yeah. And how many, you said that there's the multifamily you own as well? Or is it single family?
sorry,
Did you say you owned multifamily and single family as well?
multifamilies, yeah,
Okay. How many units did you say?
about 40 units.
Okay. How many, is that one property, one 40-unit property?
No, no, no. There's separate properties in separate neighborhoods. So, Boston is a very historic city where you have
Right.
these brownstones with, 4 units, 5 unit buildings, anything ranging from 3 to 6 units in a brownstone, could be 3 to 10 units. Some of them are, half floor units. So but because such a large population resides in Boston, which is a student population and young population, there is a continuous demand for uh, rental property. So,
Yeah. Yeah. And one of the reasons why Jazz joined the group and we're going to work together is because you've been doing a lot of this with your own capital.
yes,
Right. And now you want to kind of grow and scale using other people's money and start syndicating deals.
that's exactly right. Yeah,
Right.
that's the goal.
That's the goal. Yeah. And someone like Jazz, it's you guys obviously have a lot of experience and the biggest, you have such a good track record. And I think we talked about this, and we'll talk about this on our one-to-one call, but have you put together like your sort of presentation of you and your company and your pitch deck and your experience?
I put a small sponsored deck. I think I emailed it to you. Did you see it in your email?
Yeah. Oh, that's right. Oh, I thought that was the existing project deck. Let me see this.
No, it just has slides of different projects I've done, awards that we won over the time, and all that. So some of
Got it.
them have links in there. You can see, we've received number of awards as well. So
Oh, here we go. Yeah. Yeah. Oh, yeah. Yeah, these are the projects that you've completed. Nice. Good to see you, Reggie. Reggie came to our event last night. In Atlanta, there's the Southeast IMN multifamily conference was last night.
okay,
My wife gave birth to our daughter on Thursday, so I was been in the hospital since until Sunday.
Oh,
So
congratulations.
yeah, thank you. I was supposed to moderate this panel on distressed asset buying, but I was not able to make it. So my law partner stepped in, and then we did have an event after the conference at this this restaurant. So it was good. But Reggie came out. Reggie's a local Atlanta guy, and it was good and I was able to make a lot of connections with him and for him. And Reggie, I think you had a good time at the event, right?
I had the what?
You had a good time at the event last night.
Oh, I sure did. No, I appreciate the invitation. It was great connecting with all those folks and seeing some of the group here. You know, any event you got like that, I will make any effort to go to it.
Yeah, awesome. Awesome. Very good. All right. Well, still waiting on a couple more, but we can obviously get going. I wanted to, we'll go through kind of a Q&A if anyone has any specific questions. I know we've got individual goals, and then I want to talk about kind of capital raising strategies and where we are with that, and goals towards, steps towards reaching that goal. And then Benoit, I wanted to check in with you on the mobile home park that LOI that you submitted, because I just saw the correspondence with the broker.
Yeah, you did?
Oh, you there?
Yeah, can you hear me?
Barely. Yeah, maybe it's my speaker. Yeah, Benoit has
maybe that's
he found what is it, a 50 pad mobile home park development here in Atlanta, Georgia for $3.5 million. And I actually underwrote the deal with him yesterday, and it actually pencils out pretty well. I don't know if you guys have done mobile home deals. Reggie, you said you did, and I wanted to connect you guys maybe on this opportunity, because I think it may be a good one for you guys to partner on, especially with Reggie having mobile home park experience. This park is out in Covington, and it was Benoit is at 49 units, right?
correct.
Yeah.
I mean, I have a friend who's sort of mutual friend with other people, and he's got a company called AutoCamp.
Okay.
And that's all they do.
Auto camp.
Yeah. And that's all they do. They do mobile home. That's exactly what they do.
Oh, interesting.
Like they buy mobile parks.
Yeah.
Oh, if this is I'm looking at the website now. These are like high-end bougie.
Yeah.
High-end bougie, like destination RV parks, it looks like.
Yeah, exactly.
With Airstreams and
I think they have the inventory of, not high-end product as well. So, but this is all they do. So,
oh wow. Well, one thing we put together, and this is kind of an interesting strategy, I guess it was Benoit's strategy, that we wanted the seller to manage the park after we closed, because it just makes sense. He's run it for 26 years. And we put kind of an earn-out provision in the LOI. If you know what that is, that means you're going to get the full purchase price, but you're going to delay receiving some of it until certain milestones are hit. And in this instance, the milestone is you manage the park for 9 months, you achieve 90% or greater occupancy for the entire 9-month period. If you do that, then you'll get your extra 20% of the purchase price. So it's an interesting way. That's how a lot of private equity deals are structured. When private equity comes in and buys a business, and they want the founder is the seller, a lot of times the founder will not get the entire capital until they meet certain hurdles. And a lot of times the founder will be employed as an employee after private equity comes in and purchases it. So it was an interesting structure Benoit came up with. And as I thought, we got a lot of pushback on the email. The brokers were not happy about that, or the sellers were not happy about that offer. Did you
They're
notice
saying they
that,
don't
Benoit?
want
Go ahead. I can't hear you. I don't know if it's your phone or what, but it's hard to. What were you saying?
It looked like he muted himself now.
Yeah, you're on mute, Benoit. Yeah. Yeah, so anyway, we're kicking that around. Reggie, I think I want to get you involved in the deal as well, if it makes sense. There's a 10-unit deal also in Virginia Highlands that Reggie's interested in, that Connor has actually, Dante. Kind of a smaller deal, fully renovated, and would be a good opportunity.
Yeah,
so
I was looking at that one.
Yeah.
my
Say again,
phone,
Benoit.
I was saying my phone, because somebody called, so I missed a portion here. Did you, so we just said the seller has pushback about not wanting to continue to maintain the park after it's sold, right? So I don't know, do you have any thoughts about that, or what did you say in response?
Yeah, I mean, I'm going to respond. I can respond to him. I mean, I didn't think we were going to get anywhere with the earnout. I did not think we were going to get anywhere with the earnout provision in the LOI. But hey, what's up, Jose? How's it going, man? Good to see you. Yeah, I didn't think we were going to get anywhere with the earnout provision. So I think, asking them to stay on and manage it is one thing, but maybe we revise the LOI so we don't ask for this earnout, but we just ask them to just stay on and manage it. But if they're saying they don't want to manage it, they don't want to be a part of it anymore, then we have to revise that. And we've underwritten, a management fee in the underwriting. So I think it's, if they don't want to stay on, we can just find another property management company.
So what's the advantage of keeping them on?
Yeah, good question, Benoit. What are your thoughts on that? What was the advantage in your mind as to why you keep them on?
Well, two reasons. Number one, they're selling us at a 8% cap rate, but they're doing all the management themselves, which means currently they don't have any management costs. Therefore, if we buy, it's going to cost us more money, right? And number two, the added value is increasing the rent. However, we've already increased the rent on January 1st, so we cannot do another increase until next year. And right, so I wasn't sure about increasing management costs if we can't get that other increase for another like 9 months, right? And I think also I think it'd be good to have for the transition, and especially if you're gonna increase price and all of that, to have the same maybe management, I think could be easier on people. I don't know, than just like new people and hey, we're jumping the prices now.
Yeah, I think it's fine if we just cut that piece out of the LOI. We can either manage it ourselves or get a management company. Because like I said, when we underwrote it with an 8% management fee.
Mm-hmm.
And it's still was hitting a 20+% return.
Mm-hmm.
Yeah.
Okay.
So I want to pause quickly and just say hello to Jose. Jose's kind of a recent new member as well. Jose, you want to give us your 30-second elevator pitch?
Yeah. My name is Jose Galindo. I'm in Texas, San Antonio, Texas. I've dealt a little bit of real estate on the side, mainly wholesaling single family home. I am now trying to dive full time. My ultimate goal was always to get into, multifamily investing. And since I'm giving full time back into real estate, might as well just go head into that, because instead of using the steps to just go straight into multifamily. So that's kind of where I'm at right now. I'm mainly looking for deals in, Dallas, Fort Worth, the Austin area, and San Antonio.
Got it. I know Austin was overheated for a long time and kind of crashed. It was a darling of the multifamily world for a while.
Yeah, I'm mainly looking into like the like outside like Georgetown, Pflugerville, kind of these small towns that seem to still keep growing,
Yeah.
just not in Austin itself.
Yeah, there's a guy I want to connect you with, Jose. His name is Keith Clay. He's in Dallas. He's a real estate broker. And he was looking at like a 20 unit deal in Dallas for a while. I'm not sure what happened to him, but I'll connect you. Shoot me your email or your phone number, and I'll connect you with him. He'd be a good resource. He's got a lot of off market deals. He's trying to sell a lot of large stuff, but I think he's got smaller connections as well.
Okay, yeah, I appreciate that. I'll shoot it
Yeah.
to you in the message.
Yeah, for sure. Manesh, what's up, buddy?
Todd, man, we were all here for you.
How
I
are
showed
you?
up at your panel. I'm like,
I
my
know.
man Todd is going to be there. And I hear you're having your sixth child, man. Congratulations.
I know, thanks. I heard it was the talk of the town in the conference because everyone was like, "This guy's having his 17th kid and he can't can't make
It
it."
was funny. It was funny. Yeah.
Yeah.
But we missed you, man. You should.
Yeah, thanks. Well, we had our after party after I made it to the after party
Where were you?
at 5 churches afterwards. So it was a little bit lighter than last year, but it was still good.
Oh, I didn't know about it, man.
Yeah.
Where if you had it? Your or was
Yeah,
it a part
Robinson
of the?
Fraser. Yeah, so the firm had it. So we had a little after party.
Awesome. I missed it
So
because I was out partying with the rest of the crowd, and we ended up
yeah.
being outside till 2 in the morning.
Oh my
It was
God.
crazy.
God. Um, awesome. Well, that sounds good, man. Good to see you. Sorry I missed you. Actually, Dante, we should maybe connect with Manesh offline because he owned the student housing in Milledgeville and
Okay.
may have some handyman. We need a handyman, Manesh, to help us with some of these unit turns. And I don't know if
Okay.
anybody down there.
Okay. Yeah. There's a bunch of people that I know I used to use. I can definitely
Right.
connect you guys there.
Yeah, perfect.
That would be
Awesome.
perfect. Love it.
Absolutely.
All right, very good. All right, well, let's talk a little bit about kind of capital raising strategies. We talk about this a lot in the group, and I want to just kind of highlight it again. For those that are looking to raise capital now, raising capital, as everyone knows, is a it's a marathon, right? It's not a sprint. It requires consistent messaging and nurturing of your investor relationships. And if you're just getting started, those investor relationships can be your friends and family, right? Your existing friends and family, but having them, kind of turning the conversation from, "Hey, you're just my buddy. I know you work, you have a high paying W-2 job," or, to "Hey, I'm now investing in real estate and I'm accepting investment from my friends and family to help preserve wealth and help grow wealth passively." I actually had a call today. Somebody referred an investor to me. This guy's a dentist, right? He has a high W-2. He's got his own dental practice, and he referred to me and said, "Look, I need some tax strategies, right? I own some real estate, I own some land, and I'm paying a shitload of taxes. Like, what can I do?" And my first answer was, you need to invest in some real estate as a limited partner because you need to get that bonus depreciation, and then you'll start getting losses on K1s, paper losses from your K1s. That's going to offset your tax liability. And being a dentist, owning his own practice, it's a little easier to do that because I'm not sure if you guys know this. I know some of you do, but in order to offset your passive losses, your income with passive losses, you have to be designated what's called a real estate professional, right? So those that do this full time are obviously real estate professionals. And if you have another job, but you also invest in real estate, you need to do it. You need to participate in it at least 1,000 hours a year. And if you do that for 1,000 hours a year, then you qualify as a real estate professional under the tax code. So I ran into this issue with another client, we were structuring this investment opportunity. He had an investor coming in that was, going to invest a couple $1 million, and he wanted to make sure he was getting the tax benefit. And so I got on the phone with the CPA, and the CPA, was asking a lot of poignant questions, and the answer was, yeah, he's going to get a loss, but whether he can use that loss to offset his tax liability really depends on how he's qualified, with the IRS. And so he needed to be considered a real estate professional. And that's literally a designation your CPA can just make for you when he's filing your taxes. But it's a little bit of a nuance that a lot of people don't know. They just think, hey, any LP can get the bonus depreciation, and that's generally true, but you can't use it unless you have this designation.
How is LP distribution tax otherwise? Capital gains, right?
Yeah, capital gains, right?
Yeah.
Yeah. LP distribution is exactly taxed as a capital gains.
Do you know by any chance what that tax code is?
To be a real estate professional?
No, the classification for capital gain, for them to get a K1 under a capital gain classification.
Let me look real quick. I'm looking at my tax book from law school, but I don't know if off the top of my head.
You can tell me later, yeah. So
yeah,
because that's a selling point, for an LP.
Yeah, exactly. Yeah, that's always the there's really the advantages of raising capital and getting investments. What you're selling to these investors is the peace of mind of having your money work for you, right? You're getting better returns than the stock market, and less volatility than the stock market for sure, but better returns than like certificates of deposit and money market accounts. And then the tax advantage is 100% the best.
So I didn't. You can also pass on the depreciation to the LPs.
Yeah, exactly. Yeah, typically the GPs can get depreciation as well, but the way the operating agreements are drafted is it's kind of a, you can kind of just, unless it's stated otherwise, you can craft the depreciation really in any way that you want to, right? This other example, there was an LP that was like, I need like $2 million of depreciation, so I'll invest, but you got to make sure I get this much depreciation.
Mm-hmm.
And so you can do that. You just got to make sure you specially allocate it in the operating agreement.
Got it.
Yeah.
But then when you dispose of the asset, they have to pay that depreciation back.
Well, right. So that's the concept of recapture. And that's what I was telling this dentist today, was like, look, Uncle Sam is going to get his money, right? Either now or later, right? So you can, and even on our Millersville deal, like, for 2025, we're going to have depreciation. But if we sell the deal in 2027 or 2028, we're going to have to recapture all the losses that we took, because with Trump back in office, he's going to hopefully reinstate 100% bonus depreciation. I think right now is it 60%, Manesh? Do you know?
60%, yes. 2024
Yeah,
is 60%. Next year it's 40%.
Right, but I think there's a bill currently in Congress to make it back to 100. Right.
Yes. More than likely, it might get passed this year.
Right.
And it's only on a new asset or existing asset.
Right.
Is that on
anytime you're booking depreciation?
Yeah. Yeah. So Jazz, it's IRS code 702B is the characterization of partnership income.
702B.
Yep, 702B, and then IRC 1221 is the capital asset definition. And then the actual treatment is 741, IRC 741, which is the sale or exchange of a partnership interest.
So when you have on your K1s, you normally have a code on there. which is how an accountant classifies that income. That code, is that 702B or 741?
Yeah, so it's Form 1065 is what they'll fill out. And then the code is, it depends on what boxes are checked, I guess, really, on the
Yeah.
actual form. Right. Yeah, so I don't know if it actually references the specific code section.
Mm-hmm.
But usually it's box 2, like net rental real estate income or loss, if there's interest income. And then the capital gains section is where you would select, I think 9A, it's box 9A, which is the treatment of long-term assets.
Yeah. Okay.
So, yeah. Any more thoughts on that?
No, that's just more.
Yeah, 'cause
for
Jazz,
more-
right now you're funding all your deals yourself, right?
Yes.
Okay. But I imagine you've got a wide net of a network that you could tap into.
Yeah, I have to work on that. So that it's I don't have the talent to go ask people for money. So
Yeah,
in one deal where we've had to raise the money, I used a money broker who raised the money and charged I think it was like 1 or 2% for the equity piece that
right.
so
So it's like an equity broker then.
yeah.
Yeah, and that certainly is an avenue. I mean, those guys exist. I know a ton of them. It's you can certainly go that route. It's hard to do that if you're new because equity brokers, they have to sell you as a sponsor as well. And if you're new to the game, they're not going to really have the confidence in you as a new sponsor to go out and sell you to their investors. Right, but someone with your level of experience, Jazz, then it'd be easy to do that. But you're right. I mean, to your point, Jazz, asking people for money is a skill, right?
Yeah.
I mean, it's as much a sales skill, as it is a fundamental underwriting and technical skill of like being able to talk the talk, right? Because you're asking, and I hear you. Like I don't have this problem, but there are people that are like even within my firm who like they really hate asking for like to send out invoices for clients to pay. And it's like, how are you going to get paid if you don't send out your invoices? And they just have like a hang up of like, I don't know. I'm just, they just have a thing about it saying, hey, you owe me some money. Here's the invoice. You need to pay it.
Mm-hmm.
And I think the same thing is true when raising capital. And so that's why, I would highly recommend for everyone here to really practice that elevator pitch, right? Like who you are, what are you doing, and how can you help the investor? And it's not, and I think your social media presence and kind of online corporate identity will match that. And Jazz, you don't have much of an online identity, right? Or present?
No, I mean I have like an Instagram account
Right.
for my company, but it's like I have a website, but if I have somebody interested, then I just point them towards the website and they can see the projects and things. But I have to work on that. And those are all the things I have to work on. That's why I'm here.
Yeah, exactly. That's what we're gonna do. Right. Yeah. And then we'll do that, but you have to, the messaging has to be consistent and has to be clear. Like I'm looking at, Dante's LinkedIn page, it's like multifamily investor helping passive investors build wealth with purpose-driven investments. Great messaging. People go to his page. It's like, oh, what does this guy do? He's an investor, but he also helps other busy professionals. Same with Randall, who just joined. His is, I help high net worth individuals save on taxes and generate stable income. hell, if I'm a high net worth individual, I like that. Like I love saving on taxes and generating stable income, right? So that's a great, good, consistent messaging there, and we'll work on that. Yeah, how's it going, Randall?
It's going pretty good. How about you guys?
Good, good. Did you want to give an update on the deal with the Browns with GREA?
Oh yeah. So basically in a nutshell, I went in at 5.35. The seller actually countered back. He countered back at 6 million. But the broker actually explained that he was just throwing out a number because he was saying that, hey, if I offer more, then maybe they'll go ahead and increase theirs. In a nutshell, I ended up pushing it up to 5.5. She explained to me that he was definitely more so was extremely entertained in that offer, which is also a very solid offer, and still keep me at 20, 23, 24% investor IRR.
Okay.
And I updated it and sent it their way. And supposedly he should be signing, if not this evening, sometime at the top of tomorrow.
To sign the LOI?
Yeah. Sign the LOI at the 5.5.
At 5.5.
Mm-hmm.
Nice.
And how we have it set for the hold. If I hold it for about 4 years or so, it should be worth every bit about 5 years. Even if we go to that 2031, it should be worth every bit about 8.5, if not more.
I love it. Let me pull up, because I don't know if I was on those emails.
Yeah, I had you on even when I updated it.
Huh?
Mm-hmm. I said I had you on the one that I sent over today with the updated offer.
I see it. Yeah, I see it right now. And how many units is it?
80.
Okay, and this is currently a Lura property, right? With tax credits on it?
That's correct.
Do we know so the business plan would be to go through the qualified contract process and get it out of the tax credit status?
No, so the whole plan that I actually have planned for. So remember, number one, 20% of the actual units are market units.
Okay, that's right.
But they're not at market. Also, number two, even with the affordability side, they're not at market. So my whole goal was to come in, push the 20% up, do a light rehab, as well as bring the affordability units up to market as well. And that'll automatically push everything up because each one of those units is about $150 to $200 below current market right now.
So the rent restricted properties are actually under.
They are under.
Adjusted AGI, I guess, adjusted.
Correct. Yeah,
right?
They are under.
And the market units are under.
That's correct as well. And then it's not even requiring a great deal of rehab. I mean, I went into some of the worst units, and the only thing that I would do and go inside in there, maybe throw some backsplash, take off the counters, put some granite, resurface the counters that's there, add some handles, and drop some flooring, and they're done.
Nice.
Mm-hmm.
So we'll
and
need
the property definitely look really good too. The property is definitely well kept. They have no open work orders or anything. I mean, if anything, I would say some small TLC, maybe some touch-up paint on certain areas on the stairwells and things of that sort.
Yeah.
But outside of that, it's not really a heavy lift at all.
What's the occupancy?
Right now they're at 98%.
So we're gonna go agency with this one then.
Correct.
Okay. So if we target 4.125 for agency loan, we got to raise about 1.4 to acquire, and then acquisition fees and working capital. So what do you have in the ballpark, like 1.6? 1.7?
I had in the ballpark 1.65, close to 1.7.
1.7, right? Okay. And I've got two groups right now. I've got a place between like 6 and 8 million, and then I've got another group that's got at least another $1 million to $2 million that needs to be deployed.
Okay.
So we should. And guys, let me just share my screen real quick. I want to show you Randall's offer, his LOI, because this. Let's see. Can y'all see it? Can y'all see? Okay. Yep. So look. So I love this offer. I think I gave you one. I gave you an example to use, Randall. But this offer, rather than just putting it on letterhead, you tell a story of the potential purchaser, right? So this is like a whole presentation within the offer, and that's part of your job is when you're making these offers is you really are selling the broker that, hey, you're the best buyer here, right? So check this out. So we've got an about us section, how we do it, and then our history. Right now, you know, you guys have probably heard me say this a lot, but I'm very, I'm a big believer in what we say, what we call make the most of your assets. And if your asset, meaning your history and your experience, right? So, you know, $3 billion of management of Class A properties, right? So Randall hasn't done that personally, but in his job, in his prior job as an employee of somewhere, he has managed that much inventory.
Yeah, I did. And my job, I mean, granted, it wasn't directly through Guyton Capital, but I have managed over $3 billion.
Right.
Commercial real estate.
So it's a way to sort of make it look. I mean, it's not being untrue. But it's a way to make it look like a really strong offer by kind of leveraging your experience and putting it into an offer like this. So I think this looks great. And this is my track record, guys. So these are deals that I've closed. And, you know, Randall and I will probably partner on this deal, but these are all my deals that I've done here. And so this gives the seller confidence that, hey, these guys have experience, they know what they're doing. And then here's the letter of intent. So, and I love this. There's a cover letter here. And then here's the actual terms of the offer. So you've got a $50,000 deposit. Earnest money is refundable during the inspection period. So that's good. Inspection period is 30 days. Yeah, here's the provision that I swear I die on this hill a lot. But the inspection period shall be 30 days from the date the seller delivers all due diligence materials to the buyer. We get a ton of pushback on that. And that's because usually the inspection period starts on the effective date. The effective date is the date that both buyer and seller sign the contract. In this instance, we're saying our inspection period doesn't start until you give us all the DD. Because I've been in so many situations, I'm sure a lot of you guys have as well, where you know you've got 30 days, but you don't get all the leases or you don't get everything that you need until day 10. Right? And now you've only have 20 days to review everything instead of a full 30. So a lot of times that won't make it into the purchase contract because even though sellers sign the LOI, this is a non-binding agreement, right? And it's bad negotiating. It's bad tactics to not stick by this. You know, it makes the broker look bad. It makes the seller look bad. But I've had it happen where sellers like, yeah, I know it's in the LOI, but there's no way I'm doing that. Right? Because it is a little open-ended, right? Because how do we know all the stuff's provided? Well, in the actual contract, we have language that says, you know, purchaser will confirm in writing to the seller when all the materials have been provided. And the rest of this is all pretty standard, but we do have a financing contingency in here as well. Great. So you think he's going to sign this, Randall? Oh, Randall's on mute. Anyway,
I use similar contingency, but
I'm sorry. Can you repeat the question, Todd?
No, I'm just saying. Did you get confidence from the broker that they're going to sign this?
Yeah. I mean, she was very strong on her confidence pertaining to it. She said he was definitely completely open to that offer. He received about 2 more, but they also were not that strong, of course. And then, of course, just more so my way of presenting myself to her, you know, looking forward to do business at a later time. So she's overly selling it for sure.
Yeah.
So she was very strong that she can get it done at the 5.5. Because I told her that's the max out.
Awesome. Jazz, what were you saying?
I mean, I put a similar contingency the way I've structured it. I put the pressure on the seller saying that the seller has to deliver all documents in possession within 5 business days of signing this offer. But, you know, I don't make the due diligence contingent on that date, but you can play that in future that we never got the documents in due time.
Right. And that's what happens. But then it becomes a dispute. It's like, okay, we need to extend the due diligence. Why? Because we didn't get anything until day 15.
Exactly.
And it's like, yeah, but you know, so that's a default scenario where if the contract says you got to deliver within 5 days, if you don't deliver, that's a default under the contract,
Yeah.
right? But
What that does is makes your offer look better because you're not looking for a very large due diligence period.
right,
Saying you have a certain date you have to deliver these documents by, and we only have 30 days to review it. But now, once you have your offer or letter, LOI accepted, you can renegotiate that. Like, hey guys, we haven't received these documents.
right, yeah, yeah. And typically the earnest money is tied to the delivery of the DD. So if DD is due in 3 to 5 days afterwards, then earnest money is due 3 to 5 days afterwards, right? And if we're buying it, you want that period to be as long as possible, right? So 5 days typically is what we like to put in there as far as when the earnest money is due. I'll often start with the contract and say, DD's documents are delivered within 2 days after the effective date, but then the earnest money is due, 5 days after the effective date.
Mm-hmm.
I like to see it. Sometimes I like to see if the seller's counsel catches some of that stuff. What I love doing is, the inspection period right here, it says it shall be 30 days. Well, those calendar days are business days. And I've had a couple contracts where I put in business days and they sign it and the seller's like, so now we got like 60 days, right? Because it's or 50 days because we're including only business days. We're not including the weekends. So that's kind of a little trick of the trade here. But that's also
quick. I got a quick question. I don't know if it was just a typo or what. On the deposit, it says it's rated $25,000, but in parentheses it's 50. Is there a reason, like the difference, or is that the deposit and earnest, or is that the same? I don't know.
That's a typo.
I think that's a typo. Randall, did you mean for this to be 50 or 25?
Can you repeat it again?
So in section 5,
I just seen that.
Yeah, you wrote out 25, but you wrote.
Yeah, that's an error. I'll go ahead and inform and reach out to her.
Which one did you want though, 50 or 25?
I was gonna do the 50.
Yeah, I mean that's strong.
I mean, it would make sense with a deal like this. I couldn't see why they even.
Yeah, 25. I mean, it's 5.
Right?
Yeah, it's $5.5 million. So 25 is
not even 1%.
Like that.
Yeah.
What's customary over there for earnest money?
I mean, 1% is a benchmark, I would say, but then when you're getting into higher deals, it just kind of depends. It's really kind of negotiable. It really kind of depends on how strong you want the offer to look, to the seller. So
yeah, here it's like 5%. They look for 5%.
5% of the purchase price?
Yeah.
Damn.
That's crazy.
You're doing big deals. That's a lot of money.
Yeah, I know.
I mean, if you have the money, I mean, why not? I mean, it's just, I mean, you're not losing anything, right?
Well, yeah, as long as it's refundable and you don't screw up the deadlines.
But it's always refundable, though, isn't it?
No. So after that inspection period is over, the earnest money becomes non-refundable.
Yeah, but then why would you pull out of the deal if after the inspection period is over? I mean, if you've inspected carefully, I mean, you should not have a reason to pull out, no?
Well, what happens if you can't raise the capital? Or what happens if you don't get approved for the loan? Or
well,
what
there's a contingency, no?
What's that?
Isn't there a loan contingency saying that, there's a contingency on you buying as long as you get a loan?
Yeah, there's a loan contingency, but there's not an equity contingency. So that financing contingency really only relates to the debt, not the equity.
Huh? Can you put a capital contingency? I mean, why not? I mean, I guess you're right.
I mean, you can do whatever you want, but I think that would not be a very strong offer. I mean, brokers really want, there's 3 things brokers really want. Either they're driven by price, they want the highest price, and they'll go with a risky buyer, maybe a first-time buyer, but if it's the price they want, they'll go with it. or they're driven by the time frame, right? They got to close quickly. I don't care what the price is. I need the money and I got to close now. Or they're driven by certainty of close, right? Who's the strongest offer that has been presented? And I'm going to go with that offer, right? Like price, we don't really, we want a range, but we're not exactly sure. It doesn't have to be a certain amount, time frame, or kind of flexible, but we don't want to go with somebody and then have them pull out or retrade us later. So those are really the three things that brokers or buyers rather are really driven by. And so one of my first questions that I ask a broker is what is their motivation, right? Is it time? Is it money? Or is it price? It's one of those three things. So, yeah. And then Jazz, I just want to kind of pull this up if you don't mind as well, because this is super impressive, your sponsor information. And it's good. It's good just for, other partners in our group that could potentially partner with you. But this is an awesome hotel, man. 1875 historic landmark building.
Yep.
That's amazing. So it's not this glass building here, but it's this?
Yeah, it's that building, and there's an empty lot next to it, which is the old brownstone that was probably torn down at some point. So, but we're combining it together to make one project. Initially, we were going higher, adding 8 stories to it. And there was like a glass tower coming out of the historic facade. So I couldn't raise money for that. It was just becoming too expensive. So
now, are you developing this yourself, or do you have a developer that you're working with?
I'm developing it myself. I have a partner in this deal.
Okay. And you guys, so right now it's just raw land?
Sorry? No. The building is there.
Oh, so this is the building here. This is what it looks like today?
Yeah. Well, no, that's actually a historic photo from
That's an old photo, yeah.
1875, because you can see horse buggies in there and all that.
Oh, yeah, look at that. Is this in like downtown Boston, or where is it?
Yeah, it's in a neighborhood called South End, which is the largest Victorian neighborhood in the country. So, it's rows and rows of brick brown brownstone houses. And then you this property, which is a new Gothic, Ruskin architecture, and sticks out. So
yeah. So how did you acquire this? You had an acquisition loan, and you and your partner put in the equity?
Yeah. We put the equity in ourselves, and we had an acquisition loan. It was a bridge loan till we go to permitting, and then we got it permitted, and then COVID happened, and then we've been sitting on the property after COVID because the whole hospitality market had just dried up. Now it's back in full boom, and the numbers have almost doubled of where we were pricing the hotels at, or at least the ADRs, which is the average daily rate you get for the rooms. Yeah. So because the numbers have grown, and we took the construction cost down and went for historic tax credits, the deal works very well now. So
nice. Now, is it going to be flagged, or is it just going to be independent? You're going to call it, I guess, Hotel Alexandra.
We're going to do independent because it's a small hotel, and flagging it doesn't make sense because it costs about 12% of franchise fees.
Right.
We do have a term sheet from Hilton and Marriott and IHG. They want to do this hotel, but the numbers, the NOI drops when you have to pay such large royalties and franchise fees. So
got it. And so the rest of these, looks like that's mixed use. This is existing apartment building into conversion.
Yeah, that was a gut rehab. We basically gutted the entire building out and rebuilt from inside out. So
nice.
Saving the facade. You have to do a lot of that in Boston. So
yeah. Boston preservation. And is your plan to hold these long term or to sell them eventually?
But these, everything that you're looking on that sheet, these are all sold. These are condos, except the hotel. The hotel we're gonna hold for 5+ years. So
Got it. Okay, so these are all, okay. So you develop it, then you sell individual condos.
exactly, yeah.
Gotcha. So this is amazing, and we can talk about this on our individual call. But I want to include more information about the company and more information about you.
Yeah.
Right, because that's, you want to have that personal touch. If we're using this as our launch pad to go out and raise capital, and we want to send this to people. Hey, I'm interested. You know, I'm Jazz. I'm a developer in Boston. I'm interested in, we're interested in raising capital or partnering with people. They want the project's great. You're right. They speak for themselves. They're awesome, but they still want to know, well, who's the individual, right? Who's the person behind the projects?
Yeah.
We can talk about.
Normally for the bank, I give like there's a real estate resume,
Yeah, exactly.
It
You want to
doesn't have all these photos and everything. It's more of a granular, traditional resume kind of structure.
Yeah.
But this is something new that I did this time around to give it more of images of the, projects and things like that. And people seem to digest this a lot easier than reading the resume. So
yeah, well, and there's ways to do it in like presentation format. We don't need to put a CV together, but just, you can use even like Canva or even have a graphic designer do it, where it's more of like a pitch deck for a deal, but it's really a pitch deck for you, right?
yeah.
As a main developer. Are you looking for equity still in this hotel, or?
Yes.
Okay. How much?
I will know next week on how much equity we need, because we got approved by a state grant of $6 million. If that comes through, we probably won't need the equity.
Oh, wow. Amazing.
But
Okay.
in addition to the tax credits, we'll get, $6 million state grant.
Gotcha. Awesome, man. Well, that's awesome. Yeah, we'll dive into that a little bit deeper on the individual one-to-ones. Very good, guys. Well, our time is about up. Any other burning desires? Any other questions or issues that
I do have one.
Yeah.
What are people seeing out there for if you're getting a pref equity or LP partners? What kind of returns are they looking in there?
Yeah, good question. And it really kind of depends. I mean, I think gone are the days of, it's 20 plus or bust, 20 plus returns or bust. I think that was, 2000, that was 2022, 23, 21, something like that. That's where all deals were 20 plus. I think most investors are comfortable now between, 15 to 18. We're talking IRR. And this is just for LP equity.
Yeah.
With a preferred return of, depending on the vintage, between 6 and 8%. Manesh, what are you seeing on with your connections? Would that be in line with what you think?
I find the LPs to be greedy motherfuckers. I'm sorry.
No, they are. I mean, hey.
Once they get 25%, they don't want to go any lower. And
Right.
once they get 9%, even 8% is kind of not acceptable to them. But another problem is the competition itself is not offering any pref less than 8% and a cash and cash of 6%. But I think in this market, if you like right now, as you know, we haven't had any meaningful deal making happen in the last 2.5 years, and I don't think with the I mean, if this attack hadn't happened, we would have had some interest rate cuts in the near future. But I don't think we have anything likely to happen until 2026, which means another 6 months, which means that it's like being a dentist trying to pull teeth from the investors for any sort of development projects are really getting hammered because there's no cash flow for the first couple of years. But even in a value add deal like what I'm doing, I would much rather promise 25% rather than beg people for money for 20%. So I just, it's okay if you give them 25. The problem that that you're going to run into is not the IRR, because IRR is completely time based, but the
Yeah.
distributions, you want to see if you can, back it up with like 6%, or I mean, you're gonna have to in the end raise equity for the distributions, because operating cash flow is not going to sustain it. But people are really hung up on cash flow. Like as you know, I'm a part of several fund manager groups. Like one of them is 50 managers strong. I'm also part of a couple of dentist and doctor groups where people, have a lot of money to deploy, but anytime, the deal gets stuck on cash flow, right? And honestly, the problem is there's a lot of desperate syndicators out there that are very easily able to hawk that 25%. So, if they're getting 25% IRR deal and like 6% distribution and like 8-9% pref, your deal just looks a little diluted right then and there.
Yeah. Yeah, that's a good point. And it's also, maybe location based too. So Jazz being in Boston, what's kind of the northeastern viewpoint on that? Maybe the local market there is going to be different on the distribution side.
Yeah.
And on the like the historic tax credit deal, I mean, that's, we can offer a pref, but it's not going to be income producing for a while. So you got that investor profile is really different, right? That's an investor who's got some cash sitting in a bank that they don't need, and they don't mind waiting 2 years until the project's done. Right? So that's going to be very different. So awesome. Well, sounds good, guys. I got to run. And I will be in touch on our individual calls and keep me posted on WhatsApp, what's going on. And we'll be in touch next week.
All right, great.
Thanks, guys. Talk soon.
Thank you.
Thanks, Todd.